Welcome to TheoTRADE. This is Don Kaufman. It's December 8th, 2023. Just about 80 minutes to go to the cash close here on this Friday afternoon with the marketplace stuck in the middle with SPU. Well, if you have absolutely no idea what I'm talking about with SPU, that's SPU, well, that basically means the S&P futures. That was actually the original symbol, if you will, for the old school S&P futures, but that's just indicating that the marketplace is stuck inside of a range. However, that being said, there is some very interesting price action that I'm going to show you here in just a few minutes. Look, let's get down to business here on this TheoTRADE weekend update. All right, so the S&Ps are grinding a little bit higher, but big picture first. And the big picture is if you take a look specifically at SPX, we'll actually go to the daily chart inside of the SPX, kind of zoom into this just to get a feel. The reason I call this like stuck in the middle with SPU is, well, what have the S&Ps actually done this entire week? And the answer is absolutely nothing. Because if we actually box this in really quick, this was the expected move for the entire week. We're looking for this move, up $57 or down $57. Where are we right now? Massively unchanged. So the S&Ps, again, where did they end up on the week? Well, it's not exactly over just yet, but largely unchanged. One of the surprising aspects, and I do want to talk about this right up front, is we have not touched the upper or lower edge of expected move in 2 consecutive weeks. It has been a very, very considerable period of time since that has actually occurred. In fact, you can scroll back kind of week in and week out. You can see like, oh, I found a week we didn't hit the lower edge. It's rare though, okay, to find one. And again, 2 consecutive weeks, you got to go all the way back to the April timeframe to see 2 consecutive weeks that didn't hit upper end or lower edge of expected move. But moreover, when I'm talking about stuck in the middle, what I'm actually looking at here is a 30-day. Again, this is a 30-day 1 hour. And here is some of that interesting price action. And I'm actually going to kind of lead off with this because again, it is very, very unusual. What you actually have here is, again, coming into this range, we came into the range somewhere around kind of like mid-November. And here we are, and we're pretty much, let's call it, mid-December. You're about 3.5 weeks into what is, for the most part, it's a 50-point range. Now, granted, we are presently at the upper edge of that range, but that doesn't seem to really mean very much. We were at the upper edge of the range like a couple of days before, a few days before that, a few days before that. The point being is very simply, okay, it's an incredibly tight range. Now, the other aspect, I call this low VIX, but high volatility with a question mark. And the reason I'm actually bringing this into question is, yeah, we all look at the VIX, and I've said this time and again, where VIX, I think it's just kind of a dead instrument. It's 30 days out, but the interesting aspect of this is look at some of the moves, and I'm actually going to zoom into this for a second. Again, this is 1 hour candles, 1 hour candles, and if you zoom into it, the reason I'm bringing it in, calling it into question, these are really significant moves. Now, I'll just give you an example. Like today, for example, yes, there was a jobs number, but today we traded all the way down to 45.60 and clear up to, 46.11. For the most part, do you expect 50 handle ranges inside of the S&Ps in a 12 VIX? Do you? Okay, because you're actually seeing this kind of price action literally in consecutive days, like every single day. You can say what you want. We're not going anywhere. Okay, you're right. We're not going anywhere. But we actually have some fairly high impact intraday volatility. For those of you that do trade on an intraday basis, though, it's dangerous out there. It's really dangerous because aspects like advanced decline line, like the advanced decline line is listlessly higher right now. If you take a look at ticks, for those of you that do look at stuff like ticks, okay, ticks have been negative. I mean, the ticks have actually been negative throughout a significant portion of the day, but the market just grinds higher. And one of the things that you're kind of up against in this marketplace is it's big tech. okay, and big tech kind of running the roost of this marketplace. Nevertheless, you're still stuck in the middle with SPUs, and well, we of course expect, and we really do expect this very tight range of 50 handles to likely be shattered in this next week, and it's predominantly because of the Fed. So again, right now, one of the first things I would mention on this front is you have to be very careful on an intraday basis. I think that the intraday trade is excellent, okay, but we're moving. We are moving, and again, today on a 1 day, 1 minute, obviously, let's just extract for a second what you might think about right here. Okay, that's the jobs number, which we'll talk about, the jobs number in just a moment. But you know what, the one of the craziest things is, it was the University of Michigan consumer sentiment, which, by the way, consumer sentiment was right here. In fact, I'm even going to zoom into it because that one actually, we knew it was going to come out, but we didn't expect it to actually rock markets, and it did just do that. Okay, every economic data drop that comes out, even something as absolutely as minute, and I call University of Michigan consumer sentiment completely minute. It's a survey of 420 individuals out there. Anyway, the market got rocked, okay? And it's just literally throwing a match into gasoline every time some piece of economic data comes out. But nevertheless, that's why I was talking about, like, it's kind of high volatility in a low VIX environment. And that's something that, look, if you've been around this business for years, okay, you have to kind of like reinvent yourself. And reinventing yourself is, hey, stop focusing on the fact we're in 12 VIX, man, nothing can happen. Evidently, something can happen and does happen, because in a 12 VIX, why are we getting, wild and woolly moves of 10 S&P handles off of nothing announcements, follow through in the trade? Okay, it's pretty active out there for what is supposedly a docile marketplace. Right now, by the way, is, again, a little continuation over here. Does this look like a docile marketplace? It's anything but. I mean, literally, it's anything but a docile marketplace. Okay, there's trade activity here, and 50 plus handle moves in a 12 VIX, okay, is just not normal. Now, let's switch gears a little bit. Isn't good jobs, which today the jobs number came out, I think it was 199,000, but the big kicker was the unemployment percentage dropped. It was actually slated to come in at 3.9, came in at 3.7, right? So again, it was 3.7%, which again is good, but I thought that good was bad, because if good is good and bad is bad, but no, bad is not that bad. Bad would actually be good for the markets. It's very confusing. What I'm getting at is this: good job numbers, which just came out, is very, very inflationary. If you look at consumer sentiment, the consumer sentiment is also, it's very inflationary. If people are feeling good about the economy, it's very, very inflationary. But there's a huge catch-22 in all of this, and that is, this is the March Fed meeting. Okay, the probability of a rate cut, it has diminished to some extent. And by the way, I've refreshed this a couple times today. These probabilities are constantly changing, right? And the probabilities are actually based on a live marketplace, Fed Fund futures. But the probability is diminishing to some degree of a March rate cut. And I can't believe we're even talking about a rate cut. Here we are, 525, 550. And again, there's about a 44% probability, maybe 45% chance of a rate cut right now. Let's just call it purely a 50-50. You go out to May, though, May is actually solid in the rate cut zone, which again, to me, is absolutely shocking, because a good jobs number should mean that, like, yeah, the economy is, wait, there's not going to be necessarily rate cuts. That's not the way the market's pricing it right now. So be aware of that, because the next point over here, enter the Fed. If you're unaware, or you've been hiding someplace, there is a Fed meeting coming. The Fed is coming! And when the Fed cometh, you could get a decent sized market move. So FOMC announcement. Of course, Jerome Powell also has a press conference in that one, yada, yada, yada. Okay, the reason I'd be a little bit concerned about this one, you have a decent jobs number, consumer confidence, okay, CPI. This is not going to be an easy Fed announcement. No, the Fed's not going to cut rates, but it's actually going to be that press conference that could absolutely rock markets, especially if they say, like, what are you guys? What are you, nuts? There's not going to be any rate cuts in 2024. Okay. That's the kind of thing that markets are going to be on edge. It's risky business with the Fed this next week. It just is, because you're literally playing chicken with the idea of rate cuts out there. And look, the Fed wants to stave off traders as much as humanly possible. More on that, of course, early next week and prior to that Fed announcement. By the way, the bonds, okay, are a little bit guarded, and we're going to come back to that in just a moment. But S&P, as you can see, just continuing kind of grind a little bit here on this Friday afternoon. So obviously a Fed announcement, and with that Fed announcement, plenty of risk. In fact, before I go any further, I do want to drop back over to the SPX, okay, and take a look specifically at the options chain. And the reason I'm doing this is because I want you to see, like, even though there's a Fed announcement, like, again, it's not like this big catastrophic amount of risk kind of priced in, but they've definitely bumped volatility up a bit for next week. I would anticipate both like Wednesday, maybe Thursday into even Friday, that the volatilities will pick up quite a bit as time actually goes on, meaning that a little bit more anticipation of some price action between now, Wednesday, Thursday, and Friday of next week. All right, moving on. So this next week not only holds a Fed announcement, but also holds triple witching and an S&P roll. So triple witching, S&P roll, it's kind of the same animal. It's one of the reasons I was talking about stuck in the middle with SPU. For those of you that have no idea of why I'm actually talking about triple witching, look, the idea of triple witching, okay, doesn't really mean that much to me. Like triple witching is, look, there's expiration inside of the index options like SPX. There's expiration, okay, of course, of the S&P futures contracts. And then there's, every Friday is basically expiration inside of equity products. That's why we kind of call it triple witching. Nevertheless, there's one aspect that really needs to be discussed that we haven't had to deal with in a very significant period of time, okay? And it does beg the discussion over here, and that's this. When we roll, okay, active contract right now is December, okay? We're going to roll into the March contract. Why even bother mentioning it? Like everybody's like, okay, man, I get it. Because most people that are looking at charts and so forth, they're going to get this wrong. There's Dece, okay? And then there's March. The December contract is trading basically at 46.10. When you come in here on a Monday morning, you're going to be trading at 46.63, all right? There's about almost 50 or just beyond 50 S&P handles. So why is there a big differential between Dece and March? It's interest rates. Interest rates are up. This is the first time, obviously, in a lot of years we've actually had to discuss this. Look, I've been discussing this with all of the rolls throughout the course of this year. With rates higher, the cost of carry, okay, is significant. That 50-point differential in very large part is due to the cost of carry. And you go, well, how do you know that? Look, what's an S&P contract really worth? And I'll just, cut to the chase. It's worth about $233,000 in that neighborhood. So one S&P contract, one of these is actually worth about $233,000. If you took that, okay, and multiplied it by, what we'll kind of call like a risk-free interest rate, let's just term the risk-free interest rate like 5%. All right, then you go out there and you multiply it by 5%, divided by 4. Why do I divide by 4? Because this is only a quarterly contract. You're going to figure out real quick where that 50 plus handles, okay, comes from. And that differential is normal. But here's the kicker. When you're actually charting it, and the reason I bring it up when you're charting it, you want to come in here, hit that little sprocket, go to futures, okay, adjust for contract changes, hit apply, hit OK. Very similar. It's very, very similar on TastyTrade. So I just wanted to bring it up, make sure everybody's looking at the right thing. Look, there's no concern really, okay, with, it's triple witching. It is like the last big expiration, and there's a ton of risk coming off. There's a ton of risk coming off like this week. And what I mean by that, I say a ton of risk coming off. Like if you look like, to the Friday AM settlement, and we look at like open interest, there's tens of thousands of contracts that are open in here. The second all of these come off, okay, that's a lot of hedges that have to come off as well. There's a huge amount of open interest, though, that is going to go into obviously this expiration, which can definitely create some volatility throughout the course of the week. All right, let's get back to the markets a little bit more, and let's talk a little bit about dollar and bonds. So one area, kind of a contention, is simply this. We're seeing right now a little bit of a rally back specific to the dollar. Now, the dollar rallying, categorically speaking, has actually been rather bearish for markets to some degree. Okay, to some degree. If you take a look, though, I mean, you can make an argument like that was a rally right there, and the S&Ps, what did they do in that time frame? And again, this is July straight up until like October time frame. Okay, and in that particular time frame, okay, that was not a pleasant, again, not a pleasant time for the S&Ps. And it's one of the reasons. And again, you guys can look back at this and draw the correlations. Correlation is not causation, but you can draw anything you want out of here. Bottom line is, my opinion is that the dollar, actually a bid back under the dollar, is probably not a positive thing for the S&Ps. If there's any follow through, and I've been talking about this for the last few days, any follow through to the dollar to the upside, I would expect it is going to hurt the S&Ps. Now, I don't look at anything, alone or autonomously. I would also suggest if there's any more sell side activity to the bond market, okay, that too is going to put some pressure to the S&Ps. Do we see any pressure in the S&Ps right now? Absolutely not. Unequivocally, there's nothing going on out there. So it's worth watching that, though, early next week before the Fed, because I think that the markets right now are getting nervous. They're getting nervous. And what they're nervous about is literally, as I mentioned a few moments ago, the Fed coming out and be like, okay, what are you guys smoking over there? We're not cutting rates anytime soon. That's my best interpretation, by the way, of Jerome Powell, because I look at the Fed fund futures and I go, I cannot believe they're even considering rate cuts. And we don't have inflation back to 2%. Okay, what are the people looking at? It's going to happen, man. The only way that we're cutting rates right now is if the economy is absolutely imploding. And if you look at the jobs number, that's hard to actually make that argument. And if you look at the consumer confidence, it's really hard to make that argument. Remember, the Fed wants to be data dependent. Of course, they don't want to say anything to rock those markets, but they could definitely stave off traders and basically say, like, no, we're not even considering rate cuts in the first half of the year. And that kind of rhetoric could actually drive these markets. All right. Last thing I want to mention is I was getting into this, isn't good supposed to be bad? So good jobs number comes out, and I thought that was supposed to be bad. But I'm actually going to give you 3 stocks, okay, that were really pretty much earth-shattering in the marketplace this week. And yeah, I'm a little bothered to say, okay, us bears are bothered by this. But if you take a look at Citi, all right, Citi earlier in the week, all right, they guided lower. They guided lower, that they're going to come in the lower end of their estimates. But at the same time they guided lower, they did use the phrase buyback. Okay, so as long as you're buying back your stock, you're okay. But they did, in fact, guide lower. The next one on the docket, here's another interesting one, Google. Okay, Google ripped to the upside. Look at the auto expected moves. Okay, I was talking about this literally on the Wednesday video of possibility of it cracking the lower edge of the expected move. Well, they came out with their new version of AI, okay, that rocks the market to the upside. This morning, however, the video they released of that AI, they basically said, well, we kind of fudged the video a little bit. If you missed that one, it's well worth watching on Google, okay? But the video is, it's not real. It's not real, meaning that their AI is nowhere, okay, nowhere near what they kind of delivered in that video. And the marketplace, and I just want to show you some of the price action in here. The marketplace definitely was punishing them until it rallied back up to some degree over there. Again, and the last one, and this is probably, I saved the best for last because I definitely hold positions inside of Lululemon, okay? Lululemon also, okay? This is guided lower and had a rougher third quarter than expected and then guided lower. Doesn't matter. They actually announced stock buybacks. And this one is amazing because it didn't just rally. Okay, it actually cracked the upper edge of its expected move. Right, all 3 of these. Again, it's a sign of the times of the marketplace. fundamentals simply don't matter and technicals don't matter. Okay. Right now, it's about AI, it's about stock buybacks, and there's nothing else. The other aspect, whatever news breaks, is just a catalyst for markets. And I know people look at this and they go, yeah, it's going to be buy at any price at any time. It is just that until the Fed actually changes some of that rhetoric. Again, that's one of the reasons I'm saying it's really risky business with the Fed. Last, but definitely not least, we're going back to the SPX. Why we go back to the SPX? Kind of gauge risk for this next week ahead. Look, we're coming towards the closing bell over here. Still an hour left in the trading day. A lot could actually happen, but I'm going to tell you right now, we basically sputtered along. In fact, we got close to hitting the lower edge of the expected move on Wednesday, rebounded a little bit on Thursday, and here we are on this Friday. We're just a hair above where we started the week. But the important point, here is we started adhering to the expected moves, but the ranges to me look really big. And I keep reiterating that because, again, kind of feel like, we're stuck in the middle of the marketplace. I think we're ready to really start rocking right now. Volatility may come raging back. And most of the time people be like, nah, they'll wait until the first of the year. We're not waiting until the first of the year. We're actually going to have some volatility. So we just came off of a week, which was plus or minus roughly $57 expected move. So what are we looking for this next week? Okay, and this next week, yes, it does again hold a Fed meeting the full 7 days of the week. You're somewhere around like a $66 move. Now, okay, there is some interesting aspects of that. And first of all, obviously, the expected move is higher than the previous week, but that's predominantly because of a Fed announcement. The cautious tone I have over here, that number, okay, even a little bit of volatility like on Monday could cause that number to actually spike quite considerably. So hands and feet inside of the vehicle over here, yes, we are anticipating a hair more movement into next week. My caution, though, is if the Fed does anything outside of coming on stage, answering a few questions and getting out of there, could have some rockin' volatility to this marketplace. With that, that's it. Stuck in the middle with SPU. Thanks everybody for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.